As we are all trying to cope with the crisis at hand, possibly it's time for a bit of an economic history discussion. What are the most important looming macroeconomic factors surrounding this current COVID-19 pandemic? That is the question. Which are the issues that you should be aware of is the second question. Our chief equity strategist and economist, John Blank, is here to fill in some of those blanks for us. John, the COVID-19 epidemic is by far the most challenging health crisis many of us have witnessed in our life, but you've written that this time is different from other pandemic crises this country has had to endure. Is that from an economic impact perspective?
Well, the last time we saw something of this magnitude was 1918, which was the World War I era, Terry. So there was an entirely different economy, regulatory structure, and understanding of health crises like this. So the benefit of the last 100 years of time is going to come into play. And you're seeing that, I think, most of all in the rise of the testing numbers. If you looked at the surprise of this whole thing in March, where we had almost no testing infrastructure, the discussion of the testing infrastructure across April, and now, the United States having testing per capita numbers, and overall testing numbers that are respectable and at levels of, peers like Germany and Taiwan and so on, Spain and the UK. That's telling you that, we got the surprise behind us, and now we're going to see it. More and more groups, even if they're at the state level, have the infrastructure to test and contact trace these sources of infection. And that's the way we suppress the disease from here now in May going forward, because yes, we are going to all start to mingle some more, which means we've got to figure out where these outbreaks, when they happen, who is infected, and just track down everybody who gets it and keep them out of the population. So the game is changing, and this is the game that we know we have to play, and this is what we've learned from history. And so the infrastructure, as every week, every month that goes by, is going to keep improving. And then somewhere out there in the fall or even in the winter, vaccines will start to roll out, first to the health services and then on to the rest of us. And all of this is going to slow down the fear and raise the amount of activity. So it's really going to be, like they say, California had 4 phases. We're in phase 2 now. Phase 4 would be when the stadiums are filled again. So what we're looking at for the next 6 months is going from 2 to 3 in bases like this, and then 4 when we actually see the big stadiums filled and sports events happening will probably be next summer.
So what are the 2 most important macro demand indicators right now?
Well, this is an interesting subject. I would say yes to the idea of looking at the jobs numbers, but I would say no to the idea that the absolute number of jobs losses is making a lot of impact on me. What I do pay attention to is the types of jobs, the types of industries that are letting people go, and the types of discussions that are surrounding furloughing and bringing people back, and how people's balance sheets are happening. So I think when you're looking at it, you have to be specific to the public health nature of this crisis and drill down into the dimensions of people's experiences, because it's going to be way too easy to say, oh, we've got 36 million people unemployed, more than the Great Depression. That's not relevant to the Great Depression when people were sitting around burn barrels with sticks of wood and were homeless. This is people who are on furlough in their homes making $600 a week from the government plus whatever they have in savings, and riding this out for 3 months. And yes, it looks terrible from a top line data perspective, but if they're just furloughed, or if 80% of them go back to work as they plan to in 2 or 3 months, it's really not a comparable number. So I would tell anybody that macroeconomics is probably the wrong subject right now. You need to get into the details, the sub-indexes, the sub-discussions, and the subtleties to really get the story right.
Does that include the seemingly bullish equity market reactions at this time of release of record high unemployment numbers and shocking negative GDP growth numbers? Is that another big variable?
That's it, Terry. That's Exhibit A. So here people are screaming the market's too high, and they're not understanding, A, the market's going sideways in a volatile fashion, which is a market that's telling you that a lot of these numbers at the top line are not what they're recognizing. They're recognizing the subtleties of these stories and discounting that subtlety. So if it sounds like 36 million, the market's really saying 10 or 15 million unemployed. And that's, 6%, 7% unemployment. It's not a good number like we were at 4. But if we're at 7, 8% unemployment right now, there's no reason the stock market should be at 2,900. And that number, 8%, you're not going to see it anywhere. I just called it out because I had to condition it on all kinds of expectations of recovery of jobs. And that's just what I'm doing. But I think that's what the market's telling. The market's saying, look, this is another subtle indicator that basically things are going to get back to a reasonable level of activity within the next 6 months. That's 85% of what we used to see.
John, as with previous negative economic events here in this country that we've seen, even as late as 2008, 2009, is it safe to assume that jobs previously held by now furloughed workers are going to be lost altogether?
Well, that's the worry, Terry. The worry you have is the longer this goes on, the more discussions management has about finding ways to automate processes or reconfigure whole groups of activity. And so, yeah, if you get furloughed beyond a couple of months and your industry structure is such that your managers say, hey, let's take advantage of this, let's restructure things, that's going to lead to more permanent unemployment for a lot of people. And so I do think the discussions around more stimulus from here or dragging out the shutdowns from here, unless there's really strong evidence of a massive wave of infections, it's probably not the right answer, because this is going to give all these corporate entities room to slice people off forever, and that's not going to help the economy. So the better idea here is that on the margin, some old decision that should have been taken get prompted, but basically people who really are in need of a job and there is work for them to do come back. And that's a subtlety, a management discussion, taken writ a million times over across the economy, but that's what we're going to have to look for to have this work out.
So all that said, and with all these variables, can you even accurately assess the current state of our economy?
I think the answer is no, Terry. I don't think anybody's being honest with you can assess it, other than to say the stock market's telling you something very interesting, which is probably a 15% decline happened, and it's probably not getting any worse. And the volatility around that 15% up or down 5 or 10% is telling you that really the market's got some optimism about the vaccines, but it doesn't have optimism about when and how soon. And that's really the issue here, is just when and how soon does the expansion, reach a level of importance and strength that the market starts to price it higher. And that, that's what markets are cool about. There'll be millions of us, speculating on that. And that's where this type of stock market, not the one during March or April, but this one in May, is worth thinking about.
More importantly, looking forward, are you seeing indicators that could be regarded as predictive regarding the U.S. GDP and core inflation and the labor market and the overall shape of a recovery?
Well, let's talk about the CPI, the consumer inflation rate. Yeah, it gets a lot of airtime now because it went down because the gas prices went down and people weren't buying apparel and whatnot. But to my mind, when I look through those numbers, we haven't seen anything happen in the rent and mortgage space out of those numbers. So that's really the issue. And that hadn't actually moved when the latest numbers came out. And then all the other numbers were, to my mind, more transient. Gas is already going to move back up. $35 a barrel now was, 15 2 weeks ago. People are shopping again. That's the prices are going to stabilize after some sales and clearances happen. So to my mind, that discussion has completely missed its mark. And the real issue for the CPI is in 6 to 8 months from now when we look at the rent and mortgage issues, because that can affect the banking issues. But I think people are way in front of the cart way in front of the horse on this whole CPI thing, because all we're looking at is transient health repression data, and that's not really relevant at this point in time.
So are you expecting an overall recovery to take a protracted period of time?
Well, I think protracted means, in my mind, the next 6 months of kind of getting, geared again, and then 2021. And I think those are the two stages people should keep in mind is the next 2 quarters, and then 2021 when we're post an election and we're post, the early stages of infrastructure development around the pandemic, and vaccines, are scaled or understood, and their efficacy is scaled and understood, and all the other antibody stories and all the contact stories and all the ICUs and the ventilator stories are all understood and in place. And that's going to be a very much more confident world. So 6 months from now is when I kind of draw a hypothetical line, Terry, but that's where I think, you can break a medium term from a long-term view down.
You've written that over the long term, new economy models are going to evolve to become the new normal in 3 broad areas. What will our new economy look like when this is all over?
Well, Terry, let's throw some stock names out there. I'll throw out one that's a Zacks number 2 rank, Taiwan Semiconductor, ticker TSM. So Zacks number 2 rank. So this is a $270 billion chip stock, pretty much the hallmark of Taiwan. This is really, they are the key science park player in Taiwan. And they are going to build a factory in Arizona now. So one of the things that's going to happen is companies that are long been in Asia with their supply chains and tied to China are going to find it beneficial to locate operations at least more concentrated in the United States. And they are a good example of that. They're going to build a factory in Arizona. Next one I'll point out is Peloton, ticker PTON. It's a $45 a share stock. This is a $12 billion market cap company, which is about biking in homes. These are kind of a fad right now. I personally would be fading the Peloton story, even though there's backlogs of people buying them, and there is a remote working surge. Once that's over, I don't see where the next catalyst comes from a Peloton. So that's a different issue here. I think people are a little, Peloton really is a story from a year or two ago that got catalyzed by the shutdowns. It certainly, came along at the right time as a good product, but I don't see where the next catalyst is. And the third one I'll put out there is AngloGold Ashanti, ticker AU. This is a number 1 ranked gold mining stock in South Africa. $11 billion market cap versus $12 billion for Peloton. So amazing how cheap it is relative to that. But again, do I think you should be buying it? The answer is I think you should be selling it because the gold story, again, is going to come off and some of the fears are going to drop. And I would be a seller of AngloGold Ashanti on these strong metrics. So you got to be careful out there with stocks and make sure you are buying the story that's going to help you in 6 months, not get caught by one of these stories that's already 6 months old.
All right, let's take a quick look at retailers. They're going to start reporting earnings for the Q1 earnings season, kind of wind things up. Some retailers are regarded as economic barometers. Anything new there?
Well, we'll see. I personally think the internet side of the story is the interesting part. The Walmart's reporting some interesting numbers. We're getting a lot of home improvement stories out of the Home Depots and Lowe's of the world. People are getting stir crazy and they're getting to those stores. But again, I think the issue will be looking beyond the next 3 months to where it plays out. And again, I think when I look at it, it's a 2021 story, and you might be surprised at how unrevolutionary this all is, and that people after 6 more months are going to kind of revert to patterns that were already in place.
That's the latest with our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.